Let's get right into it, because this past week may have been one of the most important weeks for the economy that we've seen in the last several months. We received two major economic reports. First, we got the final reading on first quarter GDP. Second, we got the latest personal consumption expenditures report. That's what's known as the PCE. That's the Fed's preferred measure of inflation. When you put those two reports together, I think they tell us something super important that we need to be paying attention to. And that's this: the conversation has changed. Things have literally flipped and did a 180. Just 3 or 4 months ago, guys, nearly all of us was asking the same exact question. When will the Fed start cutting interest rates? Today, we're asking a completely different question. What if the Fed has to raise interest rates? Now, let's start with the numbers. The latest PCE inflation report showed headline inflation running at 4.1%. That's up from 3.8% the previous month. The Core PCE inflation, which is the Federal Reserve's preferred inflation measure, where they take out the food and take out the energy, that rose to 3.4%, up from 3.3% last month. Now, what does this say? It says that basically inflation is still stubborn, and it ain't going down no time soon. Now listen, that's important because the Fed's long-term inflation target is 2%. So we're still a long way away from that. Now, let's look at GDP, okay? The final estimate for first quarter 2026 GDP was revised upward to an annualized 2.1% compared to the previous estimate of 1.6%. So basically, the economy is still growing. Now, on the surface, that looks good, feels good, sounds good, it's encouraging. So the economy continues to grow, and businesses, particularly in technology and AI, are still investing. At the same time, however, we got to think about this. Consumer spending has been revised down. So basically, here it is. Businesses continue to invest in growth while us consumers are becoming more and more cautious. So here's the real deal. Businesses are growing, but guess what? They can't keep growing if we're not spending like we were, like we have been. At some point, something's got to give. This is a different economy right now, guys. Different than what we were discussing just a couple of months ago. Back in February and March, if you guys can remember, experts were doing what? They were debating how many rate cuts could we get this year? Maybe 2, maybe 3, maybe even 4. Today, we ain't saying none of that. Right? Now, let me be clear. I'm not saying that the Fed is for sure going to raise rates. I'm not saying that because we don't know. But another rate increase is back in the conversation. Okay? The probability of interest rates increasing is higher today than it was just a few months ago. That's a big shift. The conversation has literally flipped in a matter of months. Now, if we know anything about the stock market, we know this. The stock market itself is forward looking. Right? So the stock market is not going to wait for the Fed to make a decision. The stock market prices in what investors believe is coming next in terms of what the Fed might do with the Fed funds rate. And what we've seen over the last several weeks in the stock market, we've seen expectations shift towards us having higher interest rates for longer. That's why you've seen higher bond yields. You've seen changing interest rate expectations. You've seen more volatility in certain parts of the stock market. Nothing's actually happened yet, but expectations are changing. And guess what? Expectations is what moves the stock market. So what does this mean for us? Let's get to the nitty gritty because this is what matters the most. I don't spend much time personally worrying about what Wall Street thinks or what Wall Street may or may not do. I care much more about this means for somebody who's out here trying to pay off debt, or somebody who's out here raising a family, or somebody who's trying to save for retirement and build wealth for their future over the next 20, 30 years. That's what really matters most, and that's where my attention is at. Here's the simple reality, guys. Higher interest rates, they make borrowing more expensive for consumers and for businesses. When the Fed funds rate, the interest rates go up, consumers, we typically do what? We spend less money. What happens with businesses when interest rates go up? Businesses typically borrow less money, and demand begins to go down for goods and services out here in the economy. And over time, what's supposed to happen is that inflation usually is supposed to follow and go down also. That's the basic idea behind monetary policy that the Fed is dealing with on a regular basis. The problem with that is this: higher interest rates also affect millions of ordinary Americans who are trying to get ahead. So what should we actually do? If you watched this channel before, you know good and well that I don't believe that our financial future should be determined based on one inflation report or one GDP report or one or two Federal Reserve meetings. Those reports, they do matter. I get it. But those reports shouldn't control our financial lives. If your financial plan changes every time a new economic report comes out, guess what? You probably don't have a real financial plan. You got a reaction plan. So here's what I'm doing with my own money. First, I'm not panicking, okay? There's a big difference between being informed, like I'm trying to make sure we're all informed, and becoming emotional. I'm not trying to get emotional. Some people hear higher interest rates, higher inflation, and they immediately think, oh, we got a recession coming. And then they look at their YouTube feed and they see all these possible videos that are fear-mongering and trying to make you emotional and hyped up or mad or sad. Listen, I don't do that. I'm just trying to give you the reality. And then you got other people who just assume that the stock market's about to crash. Look, I don't believe either of those things, okay? The stock market ain't about to crash right now, and we're not about to have a recession. We've had higher interest rates before, and us investors, we've continued building wealth through those periods. My own investment philosophy has not changed. I'm still simply buying quality assets. I'm still investing for the long term. And listen, could the stock market become more volatile? Or we see a big dip in the market? Absolutely. Corrections are normal. They happen. In fact, they're a regular part of investing. But that don't mean you should abandon your plan. Second thing I'm doing besides not panicking is I'm staying out of bad debt. I've said this for years on this channel. Every single dollar of interest that you pay on bad debt is a guaranteed return. Look, if you're paying 24 or 25% interest on a credit card right now, paying that balance down may be one of the best investments that you could be making right now. You don't have to outperform the stock market, guys. You simply have to stop giving so much of your money to payments, okay? That's key. And it's why I don't fool with debt on anything that's not going up in value, period. Now, the third thing I'm doing is I'm staying consistent right now. Notice, I didn't say I'm investing more because of inflation. I didn't say invest less because of inflation. No, I said stay consistent. One of the biggest mistakes that investors make is waiting for some type of certainty before they invest their money in the stock market. Well, you know, I'm not sure yet. I'm waiting on this and I'm waiting on that. Look, history shows that long-term wealth has been built by people who just kept on investing through the good times, the good economies, and through the bad economies. High inflation, recession, all that don't matter. You just keep going. And that's because this time in the market has historically been more important than trying to time the market. So don't try to time the market. Now, it doesn't mean I'm buying anything at any price right now. Of course, I'm not doing that. But it means I'm continuing to own and buy quality businesses that have competitive advantages and durable earnings and strong balance sheets and companies that have what we call pricing power. And that just means companies that can raise their prices without losing customers. Look, if you're investing for retirement that's 10 or more years away, one inflation report shouldn't derail your investment plan. The fourth thing that I'm doing is this. I'm focusing on increasing my income. Look, I don't think enough people talk about this right here, so I'm going to talk about it. Most people spend their time trying to predict what's going on with inflation or predict what the Fed is going to do, predict the interest rates, or predict the next move in the stock market. Very few people ask this simple question: how can I become more valuable? How can I earn another $5,000 this year? How can I earn another $5,000 next month? How can I develop a skill that's going to pay me more money immediately? Here's the deal. The more value you become, the easier it is to outpace inflation with higher income. That's one of the reasons that I personally believe in constant lifelong learning. One of the best investments you can make is investing in yourself. Now, another thing that I'm doing, the fifth thing I'm doing, and this one may not be for everybody, but I'm maintaining a strong cash position. First of all, I'm getting older, okay? And I want to have cash to draw from when I stop working. But also this, cash provides a couple of really important things: stability and opportunity. Look, if the stock market becomes more volatile and great businesses temporarily go on sale, guess what? People that have cash, they got options. People living paycheck to paycheck or people without cash don't have those same options. Now listen, I'm not suggesting that you move a big chunk of your portfolio into cash. That's not what I'm saying. I'm saying that there's tremendous value in always having a healthy emergency reserve and some financial flexibility in cash. And finally, this is what we all should be doing, and that is building a financial system that's going to work regardless of what's going on with the Federal Reserve or what they decide to do or don't decide to do. I don't know if the Fed is going to raise rates again this year. I don't know if the Feds are going to leave the interest rates exactly where they are right now for the rest of the year. And neither does anybody else. Nobody knows. There are educated opinions. There are probabilities, right? But there are no guarantees. We have no idea. And that's why I've never wanted my financial future to depend on predicting the Fed's next meeting. Right? I don't know what they're going to do. They got a new Fed chair in there. Who knows what direction they may go in the next few meetings. But here's the deal. Instead of trying to predict that, I want a financial system in my own four walls with my own personal finances that's going to work in different types of economic environments. A system that allows me to keep investing, keep myself out of debt, and maintain good solid cash reserves and not panic no matter what's happening, right? I want my system to keep on growing, whether interest rates are 5%, 3%, 7%, 9%, or back to 2%. Who knows? Because here's what I've learned over the years. The people who build long-lasting wealth, they usually are not the people who make the best economic predictions all the time. They're usually the people who continue making solid financial decisions while the economy is steady changing, while the global wars are happening, and while the stock market is going up and going way down. They're still winning, right? Because they're making solid financial decisions in terms of staying in the market no matter what's happening. So yeah, the conversation has really flipped in the last few months. But my financial strategy hasn't changed. I'm still buying quality assets. I'm still investing consistently through dollar cost averaging. I'm still staying out of bad debt. I'm still thinking in terms of decades, not just months. Headlines are going to change. The economy is going to change. What war that we're fighting and helping fight right now and next week is going to change. My financial system don't change. The economy may have just sent us a new warning, but don't confuse a warning with a reason for you to panic. Build a financial system that's strong enough to succeed whether interest rates go up, whether interest rates stay the same, or whether interest rates go down. That's how long-term wealth is built. Look, if this video helped you in any way at all, do me a favor and drop a comment and let me know. Smash the like button and join me next Sunday when I break down this American economy again in plain language so we all can understand it. Until the next video, peace.